So with our firm Raincatcher, we are a lower middle market investment bank, and we talk with dozens of construction industry related companies. And while there are many mistakes that can be made, there are 6 mistakes that these construction company owners make that we see on a reoccurring and consistent basis. The first is, and this usually is the case with smaller construction companies, but oftentimes we see them being paid in cash for work they've done. Most often, this is maintenance and repair level work, but they don't record it on their books. So it doesn't show up in their total sales or in their profitability. But when it comes time to sell the company, they expect to receive value for that. But no buyer is going to accept that, and no bank will back that buyer if they're going to count income or by cash that did not occur or get reflected on the books. Secondly, we see oftentimes when they know they're going to sell, they will artificially reduce certain operating expenses in particular because they think that's going to enhance their profitability. But buyers are all savvy and they all see right through that. So when they create their own financial models, they're going to add that back. They are going to calculate your expense levels at historical averages, usually over a 3 to 5 year period. So sellers don't get any credit for that. And oftentimes it makes the buyers very suspicious. Some will walk away. Some will, again, reduce their price or create more unattractive deal terms in order to mitigate an unknown potential risk based on how a business owner has treated his financials. Similarly, a lot of times they will try to manipulate either their payables or receivables. So they'll try to collect faster if they think that's going to benefit their balance sheet, or they will stall on their payables thinking that the buyer is going to take over all of those existing payables. But the concept of net working capital makes an honest man out of everybody related to that. It's a very complex calculation and usually the most difficult negotiating part of any transaction. They often also spend way too much money on CapEx, more than they need because they're enamored with heavy equipment, but they don't understand why buyers are concerned with that, because buyers are looking not only at profitability, but the amount of free cash flow that exists in the business in order to pay down debt and continue to operate the company. And if they have to spend a lot of money every year, a lot of cash on CapEx, that causes them to have to offer less for the business because they're going to take on less debt in order to service that debt. On businesses that have inventory, some have seasonality, but they all have sort of an average ongoing level of value in their inventory. So if near a sale process, they artificially reduce the amount of inventory they have on hand. Again, buyers are very savvy. They're going to see this and they're going to adjust for this in the purchase price or in how they calculate the net working capital, which results on how much actual cash the seller is going to realize when the deal closes. Lastly, one of these things we see is they try to slip through either salary reductions or big bonuses or unusual incentives that aren't a standard and normal part of the business and create a new compensation model because they think they're going to protect their employees when the new buyer buys the company. But that new buyer is going to model those additional expenses into their calculations on what the profitability of the business is going to be, and they're going to impact the valuation. You can't fool these buyers on this sort of thing because they're not just looking at 1 year to analyze the business, they're looking at multiple years. Typically a minimum of 3 years and oftentimes 5 years. And I've seen some situations which have exceptional seasonality. They may look at a historical 10-year period in order to make a final decision on their own estimate of profitability and what they're willing to offer for the business.